Welcome. If you're an investor right now, you're probably feeling a bit of whiplash. Between AI, geopolitics, and wild earnings surprises, the market is all over the place. But there's one tool that's absolutely exploding in this environment. So today, we're going to demystify options and break down exactly how investors are using them for both protection and profit in 2026. Let's just jump right in. So why are we talking about this right now? Well, look at this number, 4.6 billion. That's the record-breaking number of options contracts traded last year on CBOE's exchanges alone. This isn't some niche product for Wall Street pros anymore. It's a massive force shaping how markets move, and everyone from giant funds to everyday investors is getting in on the action. And to make sense of it all, here's our game plan. We're going to break this down into 5 simple parts. We'll start with why options are so hot right now. Then we'll cover the basic ingredients. After that, we'll walk through a super practical example. Then we'll look at an expert forecast for 2026. And finally, we'll zoom out and see how the very idea of investing is changing. So let's start with the big picture. One expert we talked to said investors are getting whiplash from the news. And that just feels so true, right? This constant up and down, this volatility. It's the new normal, and it's forcing a huge shift in strategy. It's not just about buying and holding anymore. People are hunting for more dynamic tools to navigate all this uncertainty, and that's exactly where options are stepping in. Okay, so what are these things, really? I know the word options can sound super intimidating, like you need a PhD in math to get it, but we're going to skip all the complex stuff and just focus on what they actually do. Think of them as simple tools, each with a very specific job.
At its core, an option is just a contract, and the key phrase to burn into your brain is right, but not the obligation. That little bit of flexibility is what makes them so incredibly powerful. It means you get the choice to make a move, but you're not locked in if the market suddenly goes against you.
And these contracts pretty much come in 2 basic flavors. You've got call options, which give you the right to buy something at a set price. You'd use a call if you think the price is going up. And then you have put options, which give you the right to sell. This is your go-to tool if you think the price is headed down, or if you just want to protect your investments. It's really that simple.
Okay, now this is absolutely critical, so pay close attention. When you buy an option, your risk is defined. The absolute most you can possibly lose is the small amount of money or premium that you paid for the contract. That's it. But when you sell an option, you're on the other side of that trade, and you're taking on potentially unlimited risk. If you sell a call and that stock goes to the moon, you could be on the hook for a massive, massive loss. It's a hugely important difference to understand.
All right, enough with the theory. Let's get our hands dirty with a real-world scenario to see how this all works. We're going to look at how to use options as a kind of insurance policy for your portfolio, which is one of the most powerful and common strategies out there. So picture this. You've had a great run. You invested in a big tech ETF like the QQQ, which tracks all the big NASDAQ stocks, and you're sitting on some really nice gains. But you're starting to get a little nervous, right? You hear people talking about an AI bubble or a potential pullback. You don't want to sell and miss out on more gains, but man, you really don't want to give back all those profits either. So here's the play. Your gut is telling you a tech pullback is coming. The tool you reach for is a put option on QQQ. Remember, that's the right to sell. You could buy one with a strike price that's, say, 10% below where the market is today, and that expires in a couple months. This basically acts as an insurance policy. If the market does tank, the value of your put option goes way up, and that helps cancel out the losses in your stock. And this is the absolute beauty of this strategy. As Amy Wu Silverman from RBC Capital Markets puts it, this is how you get over that fear of missing out. You bought your insurance, but you never actually sold your stocks. So if the tech rally just keeps on roaring higher, you still own all your shares, and you get to enjoy all of that upside. You've just paid a small price for some very valuable peace of mind. Okay, so we've covered playing defense. Now let's flip the script and talk about offense. Amy Wu Silverman has this really fascinating forecast for 2026 that uses options in a totally different way, not just to protect what you have, but to pounce on short-term opportunities. So the prediction is this, that MOMO, YOLO, FOMO, the momentum, you only live once, fear of missing out energy that fueled things like meme stocks and the first AI wave, is about to find some new surprising targets. Why? Because 2026 is becoming a show-me year for AI. Investors are over the buzzwords. They want to see actual results, real efficiency gains. And those gains might just pop up first in some less flashy industries, like traditional medicine, creating a sudden, unexpected rally.
So how do you play a rally like that, which might not last? Well, here's the killer analogy she uses. You rent the rally. I love this. Think of it like Rent the Runway, but for your portfolio. You get to try on the hot new trend, get that look, but you're not committed. If it turns out to be a fleeting fad, you're not burned, you're not stuck with it, it's the perfect way to think about using call options for short-term tactical bets. Let's really flesh out this investment wardrobe idea. On one side, you have your long-term commitment pieces. These are your core holdings, the big themes like AI that you believe in for the long haul. You're not selling those. But on the other side, you use options to rent the short-term trends, the quick market rotations, like maybe a sudden interest in small-cap stocks. It lets you be both stable and nimble at the same time.
You know, this whole idea of renting a piece of the market is part of a much, much bigger shift that's happening. So, for our last section, let's zoom all the way out and explore how the very definition of what it means to invest is changing right before our eyes.
Think about this for a second. The biggest force that could pull regular investors away from the stock market, it isn't fear of a crash or a recession. It's competition. It's the fact that there are now shinier, faster, more direct ways to place a bet on pretty much any outcome you can imagine.
And here are some of those competitors. You've got prediction markets like Polymarket, where you can bet directly on, say, an election outcome. You've got crypto, of course, and you've got the explosion of sports betting. All of these platforms are competing for the same dollars and attention, which is forcing the traditional markets and tools like options to evolve.
And this evolution is bringing some really sophisticated ideas into the mainstream. For example, using options lets you treat volatility itself as a tradable asset. You're no longer just betting on whether a stock will go up or down. Now, you can build trades that actually profit from the chaos, or trades that pay off when everything is boring and calm. It's like a whole new dimension of investing is opening up.
And this is exactly why these tools are becoming so important. Amy Silverman tells a story about learning from Burton Malkiel, the author of the famous book A Random Walk Down Wall Street. Now, his whole theory was that markets are perfectly efficient. But as she points out, the 2008 crash and everything since has taught us that, well, maybe that's true over decades, but in the short term, markets can be wildly irrational. And that irrational space is exactly where risk management and tactical tools become crucial. Okay, we have covered a ton of ground, so let's boil it all down. What are the key takeaways here? First, just start thinking of options as tools for a volatile world. They can be your insurance policy, or they can be a tactical weapon. Second, remember that simple put option strategy. It can protect your hard-won gains without forcing you to sell and miss out on the next leg up. And third, embrace that rent the rally mindset. You can make tactical, short-term bets without ever messing with your core long-term strategy. Which really leaves us with one final question to think about. As you look at your own investments and at the market's constant churn, it's a really good idea to ask yourself, where should I be renting and where should I be buying for the long haul? Thanks for tuning in.